Across the market today, we are seeing a lot of red across the S&P, with the majority of stocks down 1 or 2%. Now, this will give us a great opportunity to buy some of our undervalued companies, and today we are focusing on 8 beaten down dividend kings. Now, first thing we do want to mention before we talk about these companies, just because a company is a dividend king like 3M once was, it doesn't mean they will outperform over the longer term. So just a quick heads up. For example, 3M recently cut its dividend. Over the last 10 years, it is now down 17%. The same to be said for Leggett and Platt as well. Recently cut their dividend. They're also down 66%. Anyway, moving on to today's episode, we are looking at 8 beaten down. They are all dividend kings, so a minimum of 50 years or more with those dividend increases. First one we're looking at is Johnson & Johnson, ticker symbol J&J. Now, over the last year, it is down around 10%. However, if you were a long-term shareholder, you would be up around 39%. Bear in mind, it doesn't include dividends reinvested, but not the greatest performance over the last 10 years. Now, over the last 52 weeks, it is currently trading right there towards its 52-week low. We do have a double buy rating with a hold from Quant, and in terms of forward yield, pretty much the highest it has offered over the last 5 years, currently sitting at 3.39%, and the forward PE does sit just below 14. Now, in terms of this company, we can see they have a 99 score for dividend safety, the highest score obtainable, very safe, and just a few months ago, they did increase their dividend 4.2%, just above that inflationary target we always aim for on the channel, 4% as a bare minimum. Now, with each one of these, we are going to run to their valuation, getting to their intrinsic value and acceptable buy price. As always, when we do our deep dives, we do run through every single one of these models. Today's episode, though, we are going to jump straight into that final intrinsic value calculation. And for J&J, today we are getting $172. Now, bear in mind, we always add a margin of safety. We do start off with 10%, and we only execute on that number if we believe it meets our 3 golden criteria. That is a wide moat, strong financial metrics, good forward-looking data. If you believe that for J&J will buy up to $155, then we keep going till it's near that current trading price, pretty much now at around $146. So at that trading price today, you are getting a 15% margin of safety based on the estimates and judgments that we have used. And we can see Wall Street pretty much see a very similar target to our intrinsic value, although they see a little bit higher with 20% upside, and their price target is $176 for this dividend king over the next 12 months. We then move on to PepsiCo. Now, we already get a triple buy rating, Seeking Alpha, Wall Street, and Quant. It is trading right there towards its 52-week lows, and we also get another yield which is above 3% and a forward P 20.2. For those that are interested, the S&P is around 22.5 in today's market. Over the last 12 months, well, down 11%. Over the last 10 years, it is up around 81%. This, similar to Johnson & Johnson, over this period have not outperformed the S&P 500. We also get another very similar, very safe score in that dividend safety. What is nice with this company is they do tend to increase that dividend at the high single digit level year on year, and we can see they are a mega cap company. Now, in terms of PepsiCo, when we do take a look at that valuation, in terms of the intrinsic value, today we do arrive at a number that sits just under $189. And as always, if you do take value from these episodes, you do enjoy them, smash that like button, hit that subscribe and bell button so you are continually notified as they drop. So a 10% MOS would indicate a buy at $170. 15%, not too far, but not quite there yet. So it does right now sit at 10 to 15% for the MOS for PEP in today's episode. In terms of Wall Street and what they see, well, they pretty much have a bang-on number to what we have as the intrinsic value. They believe they will hit $189 over the next year with 16% upside. And as always, do let us know your thoughts in the comments below. Now, before we do move to the next stock, just to let you know, today we have released our latest free weekly article. If you want access to this or any other articles, all completely free, do click on that pinned comment below and you can start to read all of these straight away. The next beaten down dividend king, we have BDX, Becton Dickinson and Company, down again 11%, very similar to J&J and Pep. Over the last 10 years, if you were holding this company, you would be up around 99%. Again, similar to the other two, this one has not outperformed the S&P over the last 10 years. It is also trading right there towards its 52-week lows with 1 buy rating from Wall Street, a double hold, and it does have a lower forward yield, 1.63%, with a forward P sitting at just under 18. Now, the third Dividend King in a row with a very safe dividend score at 91, and we do also note a marginal above inflationary increase to the dividend, 4.4% November 23. So in terms of the valuation for BDX, and just a side note here to let you know, you can grab a copy of this model to run your own numbers through for whichever company your heart desires. And in terms of the intrinsic value, it is arriving $288. Margin of safety, 10%, a buy it to $260. At 15%, around $245. And in today's episode, it isn't at that 20%, not too far. It does sit between 15 to 20%, more towards the 20 area. In terms of Wall Street and their expectations, well, they see upside 21%. As we mentioned, they do believe BDX is a buy for the portfolio. Their price target, $282. We then move on to ITW, Illinois Tools Work, where we get a buy rating, but it is from Seeking Alpha with a hold from Wall Street and Quant. Again, a general theme with these Dividend Kings, they are trading towards their 52-week lows. A forward yield, 2.36%, and a forward P, 23.37. Now, it is down, although a little bit less than the other three, negative 6%. Over the last 10 years, it is up around 167%, not too far off the S&P 500 return in that period. We're 4 for 4 today so far with another very safe dividend score and a very nice dividend increase, 6.9%. What this indicates to me is that we will be expecting a dividend increase over the next few weeks as well with this company. So in terms of the intrinsic value for this Dividend King, we do get a value of $265, and that margin of safety at 10% does show a buy a few dollars higher than the current trading price. At 15%, you would have to wait for $225. So in today's episode, you are getting at least a 10% margin of safety. In terms of Wall Street, well, similarly, they don't see a lot of upside. They have a 10% target. Their price, $258, one of the lower upsides we have seen so far today. We then move on to Stanley Black & Decker, which is taking a little bit of a beating today. It is a triple hold, the first one we have come across. Again, trading right there at its 52-week lows, with a forward yield, the highest so far at 4.06%, and a forward P just above 20. Over the last year, well, down 15%. Over the last 10 years, down 11%, as we can see, coming all the way down from its all-time highs 3 years ago at $220. We get a safe score now at 80. Dividend growth pretty poor last July at 1.3%, well below inflation, and what we are now expecting over the next few days is an increase from this company. So let's see what the valuation. We did get a triple hold, and it was beaten down quite severely over the last few years. We're getting an 89 intrinsic value, so when we take a look at that 10% MOS level, we can see pretty much at that level right now. Whether or not that is sufficient for that Dividend King, again, you will need to do your own due diligence. And we can see Wall Street have a very similar target over the next year, $91, their target 15%. We then move on to Hormel Foods, another one with a triple hold rating. Again, very common, it is towards its 52-week lows, and with a forward yield 3.71%. Forward P just above 19, and over the last year down 22%. Over the last 10 years, it is up, although very marginally, at 26%. We get another very safe dividend score at 90 with a very mediocre increase to their dividend in November 23 at 2.7%. So the intrinsic value for Hormel Foods, where we did get that triple hold rating, is actually $30, which means we do see it trading at a very marginal premium. You could argue at its fair value. Therefore, there is no margin of safety. For those looking at 10%, well, it would be a buy around $27. In terms of Wall Street, well, they pretty much are roughly in that same ballpark as us. They do see very minimal upside of 3%. Their price target just over $31. We then move on to our first, where we have a double buy with a strong buy. It is GPC, Genuine Parts Company, trading towards its 52-week lows with a forward yield just below 3% and a forward P just below 14. Over the last 12 months, well, down 18%. Over the last 10 years, it is up 56%, but like the majority of them today, it has underperformed the S&P. Dividend safety, well, nice to note, it does look to be safe with a score of 80, and dividend growth a few months ago, again, positive to report 5.3% above that essential inflation target. So in terms of GPC, the intrinsic value, remember the average of these three, and as always, you can grab a copy of this model by clicking on the pinned comment below. The current price $136. MOS at 10% would indicate a buy at 149, 15% at 141, and at that 20% level, it isn't too far off, but we would say around a 15 to 20% margin of safety. What about Wall Street? Well, they see some nice upside. That is why we saw a triple buy with one strong buy, 26% over the next 12 months, $171. We then move on to AWR, American States Water Company, with a buy from Seeking Alpha, a double hold from the other two analysts, trading towards the lower end of the 52-week range. Forward yield 2.37%, forward P marginally above the S&P at 24.06, and over the last year, poor downtrend, negative 17%. Over the last 10 years though, it is up 122%. We get another very safe dividend score at 98 with a very nice increase last August at 8.2%. So again, we should be expecting one over the next few weeks for 2024. So the intrinsic value for AWR, we are getting to $83 with the current price at $72. That margin of safety at 10% would indicate a buy at $74. 15%, not too far off, not quite there yet, so you could say sitting somewhere between 10 to 15%. In terms of Wall Street, $80 price target with upside of 11% over the next 12 months. As always, do let us know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.